note, guys, I sent you my bio real quick, okay?
Peace, blessings, enough, holy, plenty, a lot of love to all our queens and kings in the house and also on our varied social media platform.
Hello, and welcome to another episode of Mindset Monday. I hope you had a wonderful, spectacular weekend, although on our side it was raining, but rain is important. And wherever you are, I hope you enjoyed it, whatever type of day or weekend you had. And I hope you had enjoyed your wonderful Monday, though some may have to work, others just coming back from a vacation. But I hope you enjoyed it. The important thing is we're alive and we can give thanks for whatever phase of life we are going through. So today, Monday, April
2026.
the month is done.
Yes, the 27th, you mean?
Yeah,
Yes,
the
2026.
27th. The
Yes,
month
this
is
month is
finished.
finished, done.
And we have seen so many different changes. We have seen the communication. We spoke about communication, the flow in communication in different aspects. And we want to close this month's series because did you know, or most of you know, all of you know that in the US we celebrate Financial Literacy Month. And there's so many things that we weren't taught in school, even college, to be financially aware. That's a part of communication too, because if we don't know how to communicate in different aspects of our life, we throw away the little money we have and we will not have any to take care of our families. So we have a wonderful lady who will be doing a presentation for us this evening. But before we introduce her, we will go to our money exercise. And as you know, we embarked on this money exercise since the beginning of the year. Now, as we say, you can start anytime you want, but because we started the first week of the year, so we're sharing with you where we're at. So you can tell them where we're at now.
Oh, mercy. All right. We started January 3, right? And how it works is that it's 52 weeks in a month. In the year. Goodness, 52 weeks in a month. 52 weeks
in the
year.
Yeah.
Right. 52 week, but 52 weeks in the year.
Just slow down.
Right. And of course, and so you can either do from bottom to top or from top to bottom. So each week, right? Week 1, you put $1. Week 2, you put $2. Week 3, you put $3. Week 4, you put $4. Till you reach week 52, you put $52. All right. If you're starting from the top to bottom, then week 1, you'd have put $52. Week 2, you'd have put $51. Week 3, you'd have put $50, etc., coming down till you reach $1. Right? We have started, and we hope others have started. All right, a diligent way to save. So you cannot say you don't have $1. Come on, $1. You must have $1 can save, and $2 the next week, and $3. All right, beautiful. So right now, if you have started January, then today, well, not today, but this week, end of this week, which will be May the 7th. No, May the 2nd.
Sorry. Friday would be May 1st.
Right.
The month ends on Thursday.
Right.
So that's right. Where.
So Friday will be May 2nd. So if
Friday would be
it will be $10. Saturday would be May 2nd. Yes. Sorry. The weekend. So Saturday would be May 2nd. And so therefore you would have accumulated you'll be putting in $18 with the others that you have put in 1, 2, 3 to 17. So you'd have to be putting in $18 this Saturday. So it will be a total of $171.
It might look minuscule, but a lot of persons don't have 170.
Oh yes. I remember one time, I couldn't find $2. $2 for bus fare, right? Back in the day. That was like maybe in the 70s, 80s, in the 80s, right? Couldn't find $2 from a bus fare, right? On the GOS bus. I wanted to take a bus to downtown from Crossroads.
So let them know it's Jamaica.
Jamaica.
Because we have multiplicity of.
Oh, sorry. In Jamaica, I couldn't find $2 for a bus fare from Crossroads to go downtown. All right. So yes, $100. Oh my goodness, $100. Woo, hallelujah. At that time would be a rich person. All right. And if you're doing the other way, right, you'll be putting in $35 at this time. I mean, not at this time, but by Saturday, you'll be putting in $35, which would have you at $783.
Just if you were looking at that.
If you were doing from top to bottom. Right?
Whichever way you do it, it builds momentum. Being consistent in and seeing what's going on, it makes you feel good.
Good, right? So $783 would be already in that like a saving program, money exercise that we started since January. Mercy. I'm telling you, that is great. That is great. All right. So thank you all very much. Just hide that away for us, so that we can move on to the next thing, which is yes, definitely. All right. Which is first of all, before we go into introducing our speaker, all right, you know that we have celebrated the book launch for my dear, wonderful, lovely, sweet Bononono's wife, The Heart of a servant, right? And so it's all about caregivers and using the art framework and all of that. And all of that is explained in the book, which you need to grab one at Amazon. And so we just want to do a little celebration here of my dear, wonderful, lovely Bunununu's wife.
I am so grateful to God and all present here and on the varied social media platforms celebrating with me my book, The Heart of a Servant.
Isn't she just beautiful? My goodness. Yes. So grab your book. A small little donation is there for getting it on Amazon, or you can do the what, Kindle and all of that. You have Kindle, you have a paperback book, and it's very nice, very nice. All right, and a wealth of information is actually in there. Wonderful. All right, so as we are now winding into the main presentation, of course, and we are looking at a person who with over 20 years, and I saw this young college looking girl earlier because she came on early, and she don't even look like she's at 20, but she has 20 years of experience inside of institutional finance and regulatory oversight. She built a career helping large, and when I say large organization manage their risk. Can you imagine? What?
She's structure capital and operate with governance and discipline. Along the way, she earned an advanced degree in finance and worked closely with sophisticated investment frameworks. Yet several years ago, she realized that reshaping her whole path while in the institution structured most of what she has learned around her family and learned much more. This structure helped her to study what this whole thing is intentionally. Today, she works professionally, family first.
Well, actually, really and truly, today she actually work with professionals, families, first responders, vet, like myself. Thank you very much. And mission-driven organization to strengthen financial readiness before life forces decision under pressure. And I tell you, if you haven't experienced pressure, oh my goodness, I sure you're going to experience pressure before you pass away. Her work centers on what she calls the foundational rules of money. How money grow. Everybody want to know. You want to know how money grow?
Of course.
Really and truly?
Yes.
You want to know how money grow?
Yes.
Well, you
and
need
how
to
it
listen.
Compounds
Yes.
over time.
Well, you need to listen to this young lady.
Yes.
Because she will tell you how money grow.
And how it is taxed also.
And most people in the Caribbean, they think money grow in America.
Yeah, that money go on tree in America.
so she will tell you.
I thought so too when I was younger.
So when elements are aligned intentionally, and we have been saying that over and over, intentionally. You don't just wake up one morning and money grow.
No.
It has to be with intent. Household gain, and that's why we started that money exercise, because household gain, clarity, stability, and option. when they are misunderstood, even high income, highly educated families can remain structurally exposed.
Yep.
Unfortunately. And so her approach is education first,
Mm-hmm. Mm-hmm.
calm.
Calm,
Mhm.
structurally focused
The goal is not to impress, but
to empower.
empowerment. Everybody wants to be empowered, not to sell, not here to sell anything.
But to help people see clearly enough to
Oh, mercy.
decide confidently.
Wonderful, wonderful. And so, without any further ado, we are going to now be enlightening by our presenter, who is going to help us, really help us to clarify this whole thing when it comes on to financial literacy, because it is very, very important. So without any further ado, I think that this young looking lady with 20 years plus under her belt, don't know how she do that, will now present to you financial literacy. Over to you, Queen Sandra.
Well,
Gayle.
thank you, Mr.
Thank you.
Derek and Miss Miriam. Oh my gosh, what an introduction, man! I'm telling you. I don't know. Is who not talking about is me?
Yes,
Yes,
man.
one.
Yes, man.
Oh my gosh. Well, thank you guys for having me on this evening. I really, really appreciate it. Thank you guys. As you guys said, it's education first. That is my absolute aim for my community. And one of the things that you guys didn't mention, but my passion really is young adults, young adults, young adults, young families, young people, everyone, but in particular young people. Because you know what I realized, Miriam and Dr. Derek, I said to myself, I wish somebody when I was in my 20s or 30s, the things that I literally, with all of the accolades or whatever that I have, I stepped away and recognized that I really didn't know how to structure my own household. And I said to myself, it's really ridiculous because some of the things we're going to talk about today, we really should even be learning them in high school. And I have multiple degrees, and it was the school of hard knocks, life that actually taught me these things. And then I completely restructured my whole finances based on that. So
Mm.
I appreciate you guys having me on. Hi, everyone. I am so excited to be here with you today. And I want to start by saying something that most financial professionals will never tell you guys. Most people invest before they stabilize. And that's a very strong statement to make, but it is a factual statement because I've seen from meeting with people from all walks of life, whether it's the CIO who is managing a couple of $100 billion portfolio for someone, or the little mom and pop like you and I who are out here. Most of us have been taught to invest, 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 and we think that's the first thing we're supposed to do, and that's what we're doing first before we
Mm-hmm.
even stabilize. And
Mm.
so that's one of the main reasons why I'm out here looking at this point in time. So I'm just going to go ahead and share my screen and start a presentation so that you guys can be able to see um, what I want to talk about today. Can you see my screen?
Yes.
Yes, yes.
Awesome, awesome. So, as I said before, we invest in general before we stabilize. And I know that might sound surprising because everything we've been told is contribute to your 401k, max it out, invest early, invest often. And I'm not here to tell you that that is wrong, right? That's not what I'm here for. What I'm here to tell you is that most hardworking people, moms, dads, professionals, families, business owners, we're building the top of our financial house before we've even laid the foundation, right? And clearly that doesn't work because if we think about our own house, there's no way in the sun that we can build from the top. down to the bottom. But unfortunately, that's exactly what most of us do, right? And here's the wild part, guys. I did it too. So I'm not telling you guys, what I'm not guilty of. I did that with all of my 30 years, almost 30 years in institutional compliance and pension plans and insurance companies and whatnot. I did it too. And it was after almost 30 years and all of that that I realized that I did not learn how to structure my own money at the household level. Like, we're really good at helping these companies to build portfolios and stress test it and all that good stuff, but we just are too busy to actually do that for our own households. So we've got to learn not just how to earn and invest, but how it grows, how it compounds, and most importantly, guys, how it gets taxed when you actually need it. Can I ask you guys something? When was the last time that someone sat down with you and showed you the full picture of your money? Not just, your stocks that you have over here or your ETFs or your mutual funds or whatever, just the full picture, your entire structure. When was the last time anyone did that with you?
Mm, well, before I was married, never.
Never, right? Miss Miriam?
Because I'm a part of this whole thing. I was privy to that.
Right. But before that, anybody was knocking down your door saying, Miss
Not
Miriam,
at
be you married or unmarried? I'd like to sit down with you and really see where your finances are.
not at all.
No, not at all. So that's exactly what we're going to do today. We're going to walk through three money rules that institutions have used for decades. An introduction to one of the most overlooked wealth building tool that's available to everyday families, and how you too can start building tax-free, protected wealth beginning right now with what you've got. And for those of you who just got your tax refund, be right here. Stay with me because this presentation was made for this exact moment. Okay? All right. So we're going to step into the next slide and let's talk about this. So, this is where I want everybody to lean in because what I'm about to share is something
Mm.
that should be taught in every single high school and every college in this country, and it's not. There are three rules of money that govern every single financial decision that we will ever make. And once you see them, guys, you just cannot unsee it. Like, it's just something that when you really get it, it blows your mind. So the first rule is called the rule of 72. If you've got a pen and paper, let's write that down. And this is the most powerful concept in all of personal finance, y'all. Here's how it works. You take the number 72 and you divide it by the interest rate that you're earning. And that tells you exactly how many years it takes to double your money. So at 3%, which is what many of us are making right on a CD, for example, or in a high yield saving account or something like that, if you had $10,000 and you put that in the bank, that money is going to double in 24 years, which means by the time you are, and a matter of fact, that's not, let's back up. If we've got our money in the bank, on average, we're making 1%, right? And that I'm being very generous when I say that because you and I know that they're really paying us like 0.005%. Like you see a little 5 cent or a 1 cent or something added in there, right?
Mm.
So in essence, that 1% that the bank is paying us, y'all, 72 divided by 1. It's going to take you 72 years. If you have $1,000 in the bank, if you have 5,000, it's going to take 72 years before you actually see your money double. Guess what? By the time you're celebrating your 100th birthday, congratulations, you've got 2 times your money. Don't nobody want that. That's not how we going to build wealth, y'all. But look now at 10%, what happens? That same $10,000, if we took that, divide that 72 by 10%, every 7 years that money is doubling. And so I cannot I cannot preach this enough, but that same $10,000 that became $20,000 at 100 years old, that same $10,000, believe it or not, I want you to understand that becomes $1.28 million. Y'all, it's not hard to become a millionaire. We just have to know that we should be looking to make the money in the right places, and we should be using time, because it is time and the money compounding over time that is going to get us to that journey, the end of that journey where we're going to be able to actually build wealth. 10,000 versus 20,000 at 100 years old, and 10,000, the same 10,000 versus 1.28 million at age 70 something that you could retire with. So I want you all to sit with that. Let me ask you this. Do you guys actually know what rate your money is compounding at right now, wherever you have your money, whether you're in a 401k or you're in a bank account or you're in a CD? Does have you ever thought about what rate is my money compounding at? And given that information that we know about Rule of 72 now, how hard is your money working for you? Or are you working harder for your money than your money is working for you?
See?
Because at the end of the day, let's think about it. If $10,000 can make you a millionaire, that means we need to make sure that we're staying on top of what we're making on our money, where it's at, and ensuring that it's working hardest for us. Wouldn't you agree with that, Dr. Derek and Miss Miriam?
Definitely.
Definitely, that's what I'm talking about. Awesome. So now, rule number 2, really quickly, is what I call the roller coaster wealth problem. This one hits differently once you understand the math, y'all. Here's a fact that most people have never been shown: a 35% market loss, like we had in 2008. So this is not hypothetical, y'all. Remember in 2008 when we actually lost 38% in the market? That's not,
Yep.
go look it up, Google it, whatever, chat it or Claude it or whatever. The market dropped 38%. Can you imagine someone who was looking to retire in 2008? And they lost 38% of their money. But even better, hold on, we ain't done yet. That 35% market loss, you don't need 35% to get back to where you are, y'all. Remember, you're now going to need 54% just to break even back to where you lost. So Warren Buffett says he's got 2 rules. Rule number 1, do not lose money. And rule number 2, he says, please go right back to number 1. So he's not even as caring about making a lot of money, because he knows that the biggest part of the damage, y'all, is what you're losing and how you have to come from behind in this roller coaster. And so he did not build Berkshire Hathaway on hot stock picks. He built it on protecting his base. So here's what I want y'all to consider. If your portfolio dropped 35% tomorrow, because many of us, that's where we have our money, right? In the 401k, the IRA, all that good stuff that society has told us to use. And say your money dropped 35% tomorrow and stayed down for 5 years. Would your financial structure force you to sell those assets at the worst possible time? Because you wouldn't have monies aside in order to make sure that you can wait till your money comes back for those 5 years.
Yep.
Very important, because a lot of us have money in the market, a lot of money. But if God forbid something happen, we're not thinking like, what is my liquid money that I can touch? That God forbid if tomorrow my portfolio is down 20%, I'm going to have to sell my stocks at a loss in order to make sure I have cash flow. So it's all about structure, y'all. All about structure. And then the third rule, this one is, I call it the silent killer of wealth, because it kind of creeps up on you. Because by the time most people feel it, we're already in retirement, y'all. Here's what happened. You spend 30 to 40 years putting money into a 401k, 403b, 457, any of the fours that the IRS have created and the IRAs. And then you get a tax break on the way in, right? You feel great. That's a smart move. And then you retire and every single dollar you pull out is taxable. And here's the part that really stings. Those withdrawals can actually make your social security taxable too,
Mm-hmm.
right? Just think about that. You worked so hard, you put your money away, and now you're like, oh my God, now I'm in retirement. I'm taking out, $20,000. That $20,000, you have to remember you didn't pay any taxes on it when they were taking it out, if it was a pre-tax. Because most of us are saving in our 401k and we're doing it pre-tax because we're saying, hey, I want to make sure that, I'm reducing my taxes right now. But the
Mm-hmm.
problem with that is we're tax postponing it, and now we're risking the leaving our leaving our future up to Congress and the IRS, and if you put the IRS together, it really is becomes theirs, and so like your money is really theirs, right? The
Mm.
IRS, like they get to tell you when and how and all of that, and that on
Mm-hmm.
top of it, depending on what mood Congress is in, by the time you're touching your money, you might very well be paying more taxes on your money than actually when you were putting it in. So these are very, very important questions for us to consider, and these rules of money are going to determine at the end of the day how you retire, whether you retire well or pauperized, right? Or whatever the case may be. And we, again, not knocking anything, we're just saying be aware and be sensible about how you are structuring your money along the way as you're growing your wealth. And so, my question is, what if you could actually choose how and when you are taxed in retirement? What if you could choose how and when you touch your money rather than having your money sit in a 401k and now you're either selling it at a loss or you have to pay penalties to take it out or whatever? What would that be worth to you? And this is exactly what we're going to talk about next. But first, let me show you something about insurance that most people completely misunderstand. All right, so we're talking about insurance here. When most people hear the word insurance, they think of two things: expense and death. And I completely understand that. I get that. That's how most of us were taught, right? But I want to reframe this for us today because insurance, specifically one type of permanent insurance, is a single most flexible wealth building tool that most everyday families have never been shown. Y'all, 90% of America does not know about this, but 68% of the top 1,000 companies in our country, this is what they're doing with their money. So let's think about that for a second. They're telling us to do all this other stuff over here, but in fact, this is what they're doing with their money. So let me break it down simply. There are two types of insurance: term and permanent. Term is exactly what it sounds like. You pay premiums for a set term, say 10 years, 20 years, or 30 years. And if you pass away during that term, your family gets paid. If you do not, the coverage expires and the premiums are gone. Kind of like your car insurance, right? You have your car insurance, you have your insurance on your phone. You get nothing back, but you've signed up knowing that it's going to take care of you for that term. There's a place for it. It's affordable. It can cover a specific window of time. And another beauty about term insurance that if you get the right one, right, because you've got to get it properly structured, you get the right one, it can also be convertible at whatever was your rating when you took it out. So I like this for my young families and my young adults because they probably don't have a lot of money yet, but they can take out a term, and maybe 5 years later when they now are earning better money, we can convert that and they still lock in their health from when they actually took out the term into a permanent insurance. So there's a place for it, right? Because most people outlive their term, we do want to also be very mindful that we're taking care of a permanent insurance. So the question becomes, are you paying for protection that will likely never pay out? And is there a smarter way to use that money if you have the possibility to actually get a permanent to begin with? So now, permanent insurance is a completely different conversation, y'all. This is coverage that never expires. It's yours for life. And with certain types, there's index universal life. The policy builds real cash value that you can access while you're alive. We're talking about tax-free growth, y'all. We're talking about this concept of living benefits for your family in case you have a critical or chronic illness. We're talking about emergency fund access, retirement income. Who knew you could actually retire using a policy, right? Nobody tell us these things because all we know about is, oh my God, them just want to talk to me about debt and whatnot. That's not all that insurance can be used for. And here, legacy transfer to your family, all in one vehicle. All, listen, free, tax free, y'all. That right there is the absolute. The wealthy have known about this strategy for generations. Banks use it, Fortune 500 executives use it, and today we're talking about it for everyday families like you and me. So, what if the same premium that you're paying for your insurance or that you plan to pay could do five things, five at once instead of just one? What would that change for your family look like instead of the other ways that you are putting your money aside? What if your money can work harder for you? Right? That's the lick that I want us to tap into today. So now let's go into a little bit more details about the IUL versus the 401k. Same goal, but very, very different rules, y'all. Now, I want to show you something side by side because most of us have been told that the 401k is the ultimate vehicle for our retirement savings. And listen, it has its place. I'm not here to tell you to stop using it. Please don't go quote Sandra now and say, Sandra say, I must stop use my 401k. That's not what Sandra is saying. Sandra is saying information is powerful and applied information is even better. And if you now have this information, you can sit and look at your affairs, or you can meet with us and we can help you to look at that. What I'm here to show you is what you have not been told about what happens when you compare it to an IUL across the features that matters most. So let's take a look at this. You've got tax treatment, and it shows you how the 401k can be pre-tax and taxed at withdrawal. IULs, you've already paid your money to Mr. Government, Mr. or not so favorite Uncle Sam already. And so when you put your money in an IUL, it's after tax, and now you have tax-free growth and access. Market losses. Guys, in a 401k, when the market drop, it drop. Your balance drop. That's it. Period. If you took your money out at that time, you have lost it. Or if you decide to get scared and sell your stocks at that time and don't wait for the rebound, you have simply lost it. It's gone. In an IUL, there is a floor. You can never lose money in an IUL. Actually, wait, I should say that. A properly structured IUL. I am not on here because what you're going to do is you're going to find information on IUL that is good, bad, and indifferent. But as a licensed financial professional, myself and Miriam, we're able to shop for the right products for you because we function like a financial services brokerage firm. So it's not any and anybody can actually structure an IUL the right way. So please make sure that you make a note of that. An IUL from some place might not necessarily have, for example, all of the living benefits that you should have on it. One might have terminal illness only, but what if your money again can work harder for you so you can get critical, chronic, and terminal illness on that same policy? So, for example, the IUL that some people structure might just have that, or you have to pay extra to put that on it. But when we structure a policy for you, that comes on it as a rider that you don't have to qualify separately. And we're absolutely happy and proud of that. Now let's talk a little bit more about what else. Access before age 59 and a half. In a 401k, guys, remember you get hit with a 10% penalty plus taxes. In an IUL, you can access your cash value through a policy loan at any age. No penalty, no IRS permission slip. Nobody have to give you permission to touch your money. You literally log in into your portal. You say, I want to take out X, Y, and Z. And within 24 to 48, 72 hours, that money will appear. So now you can get emergency fund access. Unlike that 401k or that IRA, where the government, remember that IRS, theirs get to tell you what you can do when you can do it. And then you've got, we talked about the living benefits. We talked about we didn't talk about, this is another one that's critical and crucial, y'all. If you get to a point where you're doing well, you maybe have a business or whatever, and you're doing well and you're not ready to touch your 401k yet. Did you know that the IRS forces you to start pulling from your 401k at age 73, whether you need it or not? And then they tax you on it, because guess what? Our favorite uncle Sam, or our not so favorite uncle, Mr. Sam, says that it's about time they start collecting some taxes now, right? So really, the aim of this is to ensure that you're making sure to start pay taxes on it when it comes on to a 401k at age 73. With an IUL, you have no RMDs. That is called required minimum distribution. And if you don't take at least that required minimum distribution, you're actually going to be charged a 25% penalty on the amount that they wanted you to take out, that they wanted you to take out. Not what you want to take out, or not because you're not ready to take out yet. When you get to 73, now you have people lining up trying to make sure that you have the proper calculation and you're taking out the right amount of money. So, looking at this comparison, y'all, which of these features would make the biggest difference in your financial life had you known about this even 10 years ago?
In the IUL.
hmm hmm I only learned about this 6 years
Good.
ago.
You
Only
see,
6 years ago.
your student is listening.
He's listening, and he's being very, very good at the listening, for real, for real, for real. Yeah, I only learned about this 6 years ago. And guys, I kid you not, I have almost 30 years of experience in finance. That's not a joke. Even though I look like I'm 20, I like it. I have almost 30 years of experience in finance, and I only learned about this 6 years ago. Well, you know what I did? I doubled down. I doubled down. My son is covered. I am covered. We're not playing, because they're not gonna be functioning with this stuff over here, and we sit over here and complain. No, we don't complain. We actually do what they're doing, because if we are going to
Absolutely.
win at life, we're gonna have to figure out how they're winning, and we got to jump on the bandwagon as well. Okay? So, really and truly, all of these things are benefits of the IUL, and we say that this should be the foundation of what becomes your financial house. So, coming down. We have about 2 slides to go. What does my time look like, Miss Miriam, Queen?
So we have 15 minutes and we want to make sure that persons,
Leave time for
if they have
questions.
questions, yes.
Yes. All right. So I should be done in about 5 minutes. We should be all good there. All right. So now you understand what an IUL is, right? Was that
Yeah,
clear enough, Mr. Dr. Derek and Miss Queen
yeah,
Mary?
full 100.
Full 100. Full 100. Okay. And I hope that our listeners are also very clear now on how an IU, what it is, but I'm going to show you how it actually works, because once you see the mechanics, it just makes sense. Your premium goes into the policy. The cash value inside of it is linked to a market index. Like, say, those of you who know, like the S&P 500 or the NASDAQ, a lot of you are familiar with NVIDIA and so on, those stocks being a part of the NASDAQ index, right? So you can pin your monies to be in invested in a proxy to those index, right? And then when the market goes up, you're going to capture a portion of that growth. Some of these, we'll structure it. It could be that the index has a cap to it, and that is normally set by the carrier. It could be somewhere between 8 and 12%. And so that would be the cap, or it could also be uncapped. Like, so if the market did 20%, you would get your 20%, depending on the index and how it is structured by the carrier that the policy is placed with. Okay? And then when the market goes down, your floor is zero. You do not participate in the loss. Your money does not go backwards like when you're in the 401k. And remember rule number
Yeah.
one that we talked about up top?
Mhm.
You remember that rule of 72?
That's 72.
Rule of 72. So if these products on average have done 9% over the last 20 to 30 years, how how quickly is our money doubling in these things? 72 divided by 9.
72 divided by 9. How much is that?
Mm-hmm.
The student, come on, student. Let me use my
The
calculator.
student is looking at his beautiful
That would
wife.
be 7.
Very
Oh,
close.
8.
8 years.
72 divided by
8,
9.
8,
Every
8,
8
Eight,
8.
8
years, that
years.
money is compounding, working hard for you
8 years.
instead of working against you. Tax free. Remember that word, tax
Yes.
free?
Yes.
And here's what makes the IUL extraordinary, y'all. It's not just one thing, it does 5 things at once. You got the emergency fund we talked about, right? You can touch it whenever you need it, as long as money has built up in it. You have wealth accumulation. This is how, if you go and look for the Rockefellers, this is how 8 generations later they have remained billionaires, because they use these policies to structure this, and then they build wealth within those trusts
Mhm.
using these policies to recycle and so on and so forth. Retirement income, that's the third base of this. You can actually take tax-free retirement, like you can turn on income further on down the road and have that become a part of your retirement income. No IRS telling you when to start or stop, no forced distribution, just freedom. That's it, just freedom, financial freedom. And here is the other part that is my favorite, y'all, family banking. This one is that you can become your own bank. You could borrow from your policy, you can repay on your own terms, you could recycle that wealth across generations. This is exactly how generational wealth is built. Guess what happened, y'all? You're gonna buy a car, you're gonna buy a house, you're gonna have to save for it. What if you could save in a vehicle as a family? Now you ain't gotta go to no bank anymore to buy no more car. You're borrowing from yourself, you're paying back yourself, and this money is staying there growing and compounding using the rule of 72, all tax free. It is absolutely fantastic, 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 y'all. And we've got to,
Fantastico.
fantastico. And we've got to learn that as families, we can come together and do family banking like this. And then the final piece is the legacy transfer. Because the IUL is a life insurance policy, your beneficiaries receive the death benefit income tax free. Every single dollar. Okay? Not based on the stock market down. Every single dollar that is in there for your death benefit becomes something that can you can transfer. So I say, which one of these speaks most to you? Where you guys are in your life right now? Which one of these five ways in which it can be used?
All.
All of them. I saw me say all of them. Yes, yes, yes. Good student, good student.
But
All of them, all of them. All of them.
yes, you
That's a
can.
complete financial
No, I just
foundation in
asked
a
a
single
question.
vehicle.
All of the one.
And
All of the
then you
one.
respond. Yeah, okay.
Yes, and this is what most people have never had access to, y'all, until now. Y'all, you have no reason to say you don't know how this work now. Everybody who has listened to this now, you have absolutely no excuse for you not to be participating in this as your financial foundation. So I want to show you something last of all that I use with every single client I sit down with. I call it the financial architecture model, and this changes how people see their money forever. Think of your finances like a building. Every strong building starts with a foundation, right?
Mhm.
You do not build the penthouse first, guys. Yeah. We,
You
we
build the
can't build the penthouse first. We can't put in the luxury finishes. We've got to pour the concrete first. But guess what happened? This is exactly what most of us do with our money. Most people build from the top down. You pour everything into the growth layer: stocks, 401k, crypto, business equity, all that stuff. That is all you're chasing. And that layer matters, but it is also the most volatile layer, y'all. Below that. No, you want inflation resistant assets. That's your real estate, that's your structured income tools. That's where you can make some extra money using some other creative strategies, and these are designed to soften the volatility above with your stocks and so on. Below that is liquidity. This is where control comes. 6 to 12 months of accessible capital is one of the most powerful things you can have, and it determines how long you can operate without disruption. But the biggest and the best part about this is the bottom, the actual foundation, y'all. This is the income protection and risk transfer. This is where your IUL lives. Protection, liquidity, your growth, your legacy all come together in this one vehicle. If income stops, this layer determines whether everything above it is gonna crumble, or it's
Mhm.
gonna fall
Or it
apart, or it's
continues.
going to actually be solid because you had a solid concrete foundation that can protect you for liquidity, growth, and legacy. And so, guys, most of us are heavily invested at the top and lightly protected at the base. And that creates fragility because when our income gets disrupted, we are forced to liquidate assets at the worst possible time. And that's the cycle we're here to break. And so today, I want to thank you for showing up and listening to me and actually going through this little talk with me. Um, these questions before that you saw here were really questions to reflect on, like, god forbid anything should happen if your income stopped for 12 months, what would you do? Which assets would carry your household if your market dropped, etc.? Those are questions to ponder, and as you're pondering them and thinking about what is your next step, these are not hypothetical questions. These are things that really happen in life. And as you're pondering that, please, we've covered a lot today, and I hope that you're walking away with this. You are not behind. You're just not fully informed yet. And that changes today because what we went through here, guys, affect every single aspect of your financial protection. And I want to ask you something directly, guys. Many of you are getting your tax refunds back right now, or you've gotten it back already. And I know that the money is calling your name: a vacation, a new purchase, the new big TV, whatever is the purchase that you're looking forward to. Something that feels good in the moment. But can I ask you a question? What if that refund could become the seed of something that pays you back for the next 30 years? Because every year we get the tax refund and we're looking forward to it. But what if that tax refund can become your tax free protected vehicle that's growing every single year? What would that be worth to your future self? And it's never too late to get started. So here's what I want to invite you to do. My business partner, Miriam, is a licensed tax professional. She works directly with people in your exact situation, people who are ready to stop guessing and start building intentionally. A personal one-on-one structure review with Miriam is your next step. She'll look at your actual situation, map out your structure, and show you clearly where you're strong or where you're exposed and what options are available to you. Or she'll set that up and we can sit with you. Your tax refund has a short window. The structure you build today determines the freedom that you're going to have tomorrow. And so, with that, if there are any questions, please let's go forward with that. Did I lose them? cheering for me. Thank you, guys. Any questions in the chat?
All right. Wonderful. Wonderful. Thank you very, very, very much. Really, really appreciate. Really appreciate. Um, thank you very much. Um,
We're
all
checking
right.
the varied.
The varying places,
Yes, to see if there are
if
any
there are questions.
questions.
Yes. All right. So it's time you can ask your question, especially for those that are on the meeting platform. If you have any questions, and maybe if you could stop share your screen so we can actually see if
Perfect.
anyone that have any immediate question.
Uh-huh.
Queen Joan or Queen Dr. Nadu or Queen Roslyn, Queen Barbara. Don't know if you have any questions here on the platform. And for those on the varied social media, YouTube and Facebook, just drop your question in the chat, or you can contact Queen Miriam. Her information is actually in the description, both on the varied YouTube platforms and the Facebook platform. All right, you can just drop it in the comments or in the chat or anywhere. We will see it because we are seeing all the YouTube channels and the Facebook platform. So anyone want to on here, go ahead, Queen Joan. Okay, I saw you unmute yourself here. All right, wonderful. All right, anyone else? Anyone? Queen Dr. Nadu. All right, I guess everything was received properly. Wonderful. Thank you all very much. Really, really appreciate it. And Queen Rosalind, go ahead.
Good evening, everybody. Dr. Derek is in to be from Trinidad too, because I in Trinidad and Tobago. So I was wondering. I came in late, but I just heard a little bit. But still, let me ask if this will be in Trinidad too. So if anybody in Trinidad could do it out there, tax wise, I don't know. So I ask a question.
For Trinidad and Tobago, I know they are licensed professionals there, but there are different things that apply to different countries. So the concepts are across is somewhat across the board. However, the specificity to a particular country, you would need to speak to someone who is licensed there to answer those questions.
Oh, okay.
Okay.
All right.
I
Thank you.
So if I may really quickly, Queen Miriam. So we're actually the company that I'm appointed with. I mean, and this is not about selling a company or not, because it's the concepts, it's the education that I want. We're actually a global company. We have expanded into certain parts of the Caribbean. As a matter of fact, this week I'm scheduling to be talking with leadership in our company to try to figure out where we're definitely in the Spanish speaking Caribbean, and I need to just button down where of the English speaking Caribbean that we're actually at, because these tools, in particular the IUL, is also being offered, and because we're a global company. But I can certainly get back. I'll get back to Miriam with that information for you. But I'm fairly certain we will, if we're not yet, we will be in Trinidad and Tobago, we'll be in Jamaica, we'll be in I'm fairly certain, because we intend to actually be in about 50 countries, and we're already in about 30 countries. So that's something that is on my to-do list this week.
Okay. You got that,
Mhm.
Rosalind?
Wonderful.
Yes, thank you, thank you. Yes, Miriam. Thanks.
beautiful. So the IUL is in 30 countries already,
So
and they are expanding to at least 50 countries very, very shortly. So yes, we have your contact information, Queen Rosalind, and so most definitely we will keep you informed as to how quickly that develops. All right. So as soon as Queen Sandra give us that information, hopefully before the end of this week, we will definitely pass that on to you. All right,
Amen.
wonderful. Thank you very much, Queen Rosalind.
So now that we have a little bit more knowledge than we had before, we can now make informed decisions. We can actually start to say, okay, now I have this information and I know where to go to get specific for my individual situation. I now have tools to work it. I won't say ammunition because we now have tools. We now have tools to work with so we can be better. So, Sandra, thank you again. Any final statement before we wrap up? You're muted and magnificent.
The mic is at the top.
My bad. Sorry. Yeah, not too much really accepting. I just want to say that information is great, but applied information is what we believe very strongly in. So sit down and take a look at your actual circumstances. I know we went through a lot today, absolutely. And hopefully you don't feel like, oh my God, you were drinking from a fire hose. If you want it to be broken down more clearly and for you to actually map out your structure, you know, get with Miriam and she can schedule. And I can also meet, myself and Miriam can sit down with you because that's what I do for a living all day, every day, working with professionals, families. And like I said, I'm really, really passionate about young adults and young families because if we knew about this stuff 30 years ago, 20 years ago, a lot of us, our lives would just look differently because we would know exactly, what to do. So, get with Miriam and get your particular situation. If you have questions, if you have any questions at all, because no question is too stupid or foolish or whatever. None of that. It doesn't matter. A question is a question, and we have answers for you.
Wonderful,
Wonderful.
wonderful, wonderful. And as we are talking about communication flow, this communication is very important for families, and we will be able to structure what we earn in the workplace or what we earn doing our own business, and then we can make decisions how to invest so we can have over a long period of time leaving legacy for our family. We hear about legacy and we hear about maybe is an old grip or whatever, but we can leave something substantial.
Tangible.
And we can live, we can use whatever we invest while we're alive, not waiting at, because that's why a lot of people think that life insurance is daunting. Don't tell me about life insurance because you want to bury me. No, you are preparing so you can have something to use while you're living and live a much more happier life. So thank you so much for all of you who are on our meeting platform and all of the varied social media. Thank you so much. And the good thing, the information is at your fingertip. You can actually go and review what was said. And if you have questions, I'll be happy to answer those questions. So before we close, we have our quote for this week. Flow with energy of your purpose and make an impact. what a great impact you can make for your family when you structure things that can help them over time. Again, thank you for watching. This is Miriam. Until next week for another episode of Mindset Monday.